you can see on this chart, when the Fed announced its last not QE program, Bitcoin ripped higher. And this time, the program isn't responding to an active crisis, it's attempting to prevent one. So whatever you want to call it, the bottom line is simple. The Fed has pivoted from balance sheet reduction to balance sheet expansion. Technically, it's not the same as QE. The bonds they're buying are shorter duration, much more cash-like, and they won't push mortgage rates down in the same way or stimulate the economy directly, but they're still printing money, and banks will behave accordingly. Credit conditions are likely to ease, investors are likely to move out on the risk curve, and assets like stocks, gold, and Bitcoin are likely to find support. As you can see on this chart, when the Fed announced its last not QE program, Bitcoin ripped higher. And this time, the program isn't responding to an active crisis, it's attempting to prevent one. My thoughts are it doesn't matter what you call it. It's balance sheet expansion. It's the new Fed cycle. $40 billion per month is already much higher than was expected over the last couple of weeks by analysts, and they've upped the first month to $54 billion. Risk should respond favorably as liquidity stabilizes. The Fed is calling it reserve management, and they're insisting that it's temporary, and they swear that it's not QE, but this is a pivot. This is balance sheet expansion. This is monetary easing. So what does it mean for asset prices? Well, until these purchases flow through to the banking system, direct price effects may be muted, but investor behavior has already shifted. You can see behind me that Bitcoin is up 3% today to just above $92,000, and the S&P 500 is just 18 points off a new all-time high. If pass-through works as it usually does, this not QE program will act just like the prior round. We are now in outright easing. The Fed is cutting policy rates and expanding its balance sheet to prevent the engine from seizing, and this may not be the pace or scale of 2020 quantitative easing, but it is phase one of what could evolve into a broader liquidity rollout, and make no mistake, it will add fuel to the fire as we head into Q1 of next year.